Yeah. Yeah, within 30 days. Yeah, because you're technically like you're just here for grad school.
Today we're talking about stock redemptions, one of my favorite topics. Very timely topic. I don't think you can go a week without some major company announcing a share repurchase program or share buyback program. Those are the layman's terms for what we're talking about. From a tax perspective, they're called redemptions. Okay? And this differs from what we were talking about previously in this chapter, which were dividends. Dividends are a one-way transaction, right? Value leaves the corporation to the shareholder. The shareholder gives nothing back, right? A redemption is an exchange where the value leaves the corporation, but in exchange for their stock being returned to the corporation, right? Hence the share buyback, share repurchase. So, publicly held companies often redeem their stock from existing shareholders. It may accomplish one or more business objectives. It could get excess corporate cash to its investors efficiently when faced with limited current investment opportunities at the corporate level. Okay? So, when there's excess cash at the corporation level, meaning above and beyond what they have for current investment, they're going to effectively want to put that to use. One way to do that is to distribute that to shareholders. They can distribute a dividend, which is, we know, taxable to the recipient shareholder at 0, 15, or 20% for individuals. If I decide to do a redemption, then depending on the test that we're going to go through in a moment, that might be a capital gain transaction for the shareholder instead of a dividend. One of the key distinctions between a capital gain and a dividend? Capital gain allows you to recover your tax basis in the stock you dispose of as the shareholder, meaning it lowers the base. Because capital gain income is also taxed at 0, 15, or 20 for U.S. individuals. So you're largely going to get the same preferential tax treatment, dividend and capital gain, but you have a lower base on capital gain. You have that basis recovery that does not exist. So that might be viewed as, and I think generally it's viewed as an efficient way to get cash to shareholders via redemption versus just paying dividends. Some companies do both, right? There's no limitation on doing a dividend and a redemption, or doing a redemption and not doing a dividend, or doing a dividend and not a redemption. It's all up to management and the board. It could be viewed for business reasons as acquiring perceived undervalued stock for future use, right? If, I'm sure in today's market, right, the stock market has come down off its highs because of the geopolitical uncertainties in the price of oil. So many companies, I believe, are out there thinking their stock price is lower than what it should be, what its true fair market value should be. So they could be in there buying in the market, buying their own shares, providing a level of buying to support prices on their stock. And the reason they're buying stock is for future use, right? If they feel it's less than what its true value is, they're buying their stock on sale. Okay? What are the two uses that typically a company makes use of its own stock? Is to fund stock options. Okay? So if they have future awards of stock or future exercises of stock options that I believe are going to happen, then they need to have stock on hand to fund those awards or to fund those exercises, right? So they may be out in the market acquiring it at a lower price to be able to fund those future exercises. The other thing they can do, what we're going to talk about later in chapter 8, is from an M&A perspective, one of the transactions that they can do is an acquisition, and they can use their own stock as consideration. So a share-for-share exchange to acquire another company. They deliver their stock to the shareholders of the target company in exchange for shares of the target company. If they can do that and buy it at a discount to what its true value is, buy it now when the market's down, the conflict in the Middle East gets resolved, market goes back up 6 months from now, they may have an appreciated asset that they can use in an acquisition, right? So, and some of these programs are in the billions of dollars. So you have a very healthy purchaser in the market that might be buying when the market is otherwise down very well. So that certainly is a reason to have share purchase arrangement. Decreasing the number of shares outstanding and increasing EPS. Some of the financial advisors like Apollo and CNBC, some of them will refer to this as financial engineering. But if you take your excess cash and you repurchase your shares in the market, those shares come in and they become treasury shares, right? When you own your own shares, so they are no longer considered outstanding. And your earnings did not change, right? So your EPS is earnings divided by shares outstanding. You lowered the denominator. Your EPS goes up. Some advisors or some analysts will think that that's just financial engineering. You're just doing this to prop up your earnings per share when you really did nothing to increase the earnings. It's just over less shares. You quibble with that or not, but that is one of the rationales that management is looking at to get earnings per share. This also signals management optimism to the public market. When a share buyback program is announced, usually all other things being equal, you see a slight increase in stock price because the market typically views that as a signal for management that they are very optimistic about their future. That they will buy their stock at today's price or a little bit lower, thinking that it's going to increase in value. Right? Because they wouldn't do it if they were thinking it was going to further decrease in value. Buy something further tumble in price. And so it signals a level of optimism maybe for management of future prospects of the business. Stock redemptions can also be used as a mechanism to separate from a disgruntled shareholder. So if you have a large shareholder who maybe is not happy with their ownership anymore, parties might want to both exit that relationship. One way they can do that is I'll buy your shares back from you and then you are no longer a shareholder. I don't have to listen to the shareholder meetings. You don't have to come to the board meetings anymore. And so we can just go our separate ways. That's one way they can negotiate that. Now, that typically has to be a sizable shareholder, right? It's not going to be any all your shares in Apple. You don't care if I'm just so usually that's a big investor. But that can happen sometimes. You hear about activist investors. Activist investors take a large enough stake, they try to get a seat on the board. If they get over certain thresholds, they make complaints about the business or things that the management needs to do differently. If it goes on for a period of time and there's disagreements, they might decide to exit that. That might be structured as a stock. Privately held companies, so much closer held ownership, so not public, and so usually you have founder or family ownership of the business, may redeem stock for other objectives. Maybe it's for succession plans. So how do we go from the older to the younger family members? And we might want to get the founder out of the business because the founder is going to go on with the rest of their lives and enjoy life and not run the business anymore. Maybe we structure that transaction as a redemption standpoint to try to give them a better tax answer, exit the business, and get the next generation. That's one way they can do that. We can provide funds to the estate of a recently deceased owner to pay the payment of estate taxes. So when you pass away, you might have estate tax due based on the fair market value of your assets. If you're a founder of a successful business, many times that's an asset that might push you up in paying estate tax. And the question is, how do I pay the estate tax if the estate doesn't have cash? One way to get cash to that estate is to redeem some shares from them to get them the cash to have the wherewithal to pay the tax. It could be facilitating the retirement of a shareholder. Get them out of the business, they go on with the rest of their lives, and get them cash to do that. Redemption are separating from the individual in ownership or management capacity as well. Obviously, family members don't always agree. On that. And so if it's a business really needs to and somebody wants to go their separate ways, that might be a way to separate in a more tax efficient manner. Lots of different reasons can drive a share repurchase arrangement. The tax rules do not necessarily guarantee or care about what the rationale is. We have very objective rules that we're going to go through to determine the tax ramifications of what we're doing. So lots of business reasons may drive it, but we're going to tax rules. Okay. The legal form of a stock redemption. Okay. This is where we're going to differ from the legal form when we look at the tax analysis of this. The legal form of the stock redemption is an exchange, right? So it's different than the dividends. It's one-sided. Corporation giving money to shareholders or value to shareholders. Nothing comes back. This is something does come back, the shares. So it's an acquisition by the corporation of its stock from a shareholder in exchange for property. If Apple buys shares in Microsoft for whatever reason in the marketplace, that is not a share redemption. Share redemption is only if Apple buys Apple stock from a shareholder, right? So you're reacquiring your own shares. And that is typically in cash, but it can be for non-cash property. Warren Buffett, Berkshire Hathaway takes large stakes over time in companies. And there was a Duracell transaction a couple of years ago. And I don't remember the exact facts on it, but he wanted to exit that business. And one way they did that is they gave him another portion of part of the business in exchange for the Duracell business. So you can get really creative with large shareholders on this as to how you structure these transactions. And if you understand what the business wants to do, and you can try to structure it in the most tax advantageous.
One thing I guess like I'm kind of not seeing on like the public side for like the stock redemption is one, just the timing perspective, and then what if like your CFO is just not a very good like capital allocator? What if he's just doing it because they have a super high stock-based compensation expense that you don't see in the income statement, but you can see in the cash flow, and you're like, well, he's obviously doing that just to pay that off. Like, couldn't that be a problem?
Yeah, so you have to be careful in when you reacquire the shares, right? Your denominator for your earnings per share goes down, so your earnings per share goes up. But if it's to fund stock options, then your denominator goes back up when you issue the shares in the exercise of the stock option. So if that's what you're doing, the share redemption is only trying to play neutral, to keep earnings per share from being negatively affected. Because if you have to fund exercise stock options and you do not have treasury shares, then you have to issue new shares, and that will inflate your denominator and lower your earnings per share, right? Which will be negatively thought of in a big way in the marketplace, right?
Yeah.
And so many times they're trying to just play neutral. I'm going to acquire shares knowing that in short order they're going to go back out, so I want to keep my denominator stable. So that's what they're doing. So if that's the best use of your cash, then yes, one of the questions would be to the CFO or the CEO is, what is your vision for the organization? Are you done growing? Because that's the best use of your cash. You're not investing in new R&D. You're not buying a new company. You're not investing in new employees, those types of things. The best use of your cash is to manage the denominator of your earnings per share. And so the correct answer is probably somewhere in the middle of that. You're not taking every dollar of excess cash and doing this, but you understand you got to manage the marketplace, but you also have to, be a leader of the growth of the company. Lots of different things can come around from this, but there is an element of, especially those large stock options, you have to manage that impact on EPS. Okay, so the legal form of a stock redemption differs fundamentally from that of a dividend. So strict adherence, if all we did was follow the legal form of the transaction, which was an exchange, I send you cash, you give me my shares back, and that would always result in the shareholder reporting a capital gain. That does two things. That's the associated recovery of tax basis. On any capital transaction, I get to recover my basis before I have any income. And taxed at lower preferential tax rates in the case of individual shareholders, right? And we do not follow, full stop, the legal form of the transaction from a tax. And so, except for specific situations, we instead characterize the transaction as a distribution of earnings from the corporation to the shareholder, which is then tested under the previously discussed rules we covered last week. First, dividend to the extent of E&P, then return of capital to the extent of tax basis, any excess goes to cap gain. So, even though the legal transaction is an exchange, we might nonetheless treat it as a distribution, which is a one-sided transaction, and we go through those normal rules we discussed last week. Dividend to the extent of E&P. Once we get beyond that, we go to return of capital. Once we get beyond basis, we go to cap gain. Okay? Without any restrictions, the reason we don't follow the legal form of the transaction is a shareholder could otherwise circumvent the rules applicable to dividends, which result in ordinary income to the shareholder with no associated basis recovery, right? It's more costly to get a dividend. So if a taxpayer shareholder doesn't want to have that happen, says instead, give me a share redemption. By structuring the corporate distribution to have a legal form of an exchange, which results in capital gain treatment, recovery of basis, and preferential tax. So it would be possible, you'll see in the way the tests are designed, are trying to prevent that abuse of just taking a legal form of the transaction to reduce the shareholder level. Specifically, a stock redemption is treated as a taxable exchange, so I do follow the legal form if it satisfies any one of the three change in ownership rules that we're going to walk through here. So the redemptions that are substantially disproportionate, complete redemption of the stock ownership, and redemptions not essentially equivalent to a dividend. So lots of words here. Let's try to parse through these. So substantially disproportionate. We'll go through that rule in detail in a moment. But it's basically looking at, did the legal form of the transaction drastically change your ownership in the corporation relative to other owners? So it's substantial, so it has to be large change, and it's disproportionate, which is relative to your other shareholders. And you'll see the objective test that the government's landed on for that. The second one is complete redemption. You no longer own any stock after the legal redemption. You're done being an owner. That's the second way we'll follow the legal form of redemption. And then the third one, redemption is not essentially equivalent to a dividend. This is the subjective portion. The first two are objective. So you can fall to the third one, but the government may not agree with you that you're not essentially equivalent to a dividend. So on the right-hand side, failure to meet one of these tests. So if you do not meet any one of those three, results in the redemption, even though it's legally a redemption, being treated as a distribution for tax purposes. Subject to the previously discussed rules, dividend first to extend to B&B, return to capital, extend to tax basis, and then capital. Okay? So if you're looking for exchange treatment, you have to meet one of these three. If you don't, go back earlier in the slide deck, and that's the rules that are going to be applicable. Okay, so let's take these one at a time. So redemptions that are substantially disproportionate. A shareholder meets this test by satisfying three objective stock ownership criteria. So you've got to meet all three of these. Okay? Immediately after the exchange, the shareholder owns less than 50% of the voting power of the corporation. So this is saying, after the legal redemption, do you own less than 50%? If you don't, if you own greater than 50%, you are not going to be substantially disproportionate. Okay? So you can imagine this is not me owning stock in half. This is Warren Buffett owning an outsized position in some corporation. Major shareholders. Second requirement, the shareholders' percentage of ownership of voting stock after the redemption is less than 80% of the percentage ownership before the redemption. So we're looking before and after the transaction. After, are you less than 80% of what you had before? Okay? And the last one, you got to meet all three, is just doing the same test but based on value. Okay, so the value of the corporation after the redemption is less than 80% of the percentage ownership before the redemption. And the reason you have 2 and 3, one's vote and one's value, is because of the presence of preferred stock. So preferred stock can be a value measure, and so you could typically fall below the vote. And if you didn't have the third prong of this test, you might still own a substantial amount of the value because you're dealing with preferred shares. So they added both of them. So this deals with vote. 2 covers voting stock, 3 covers preferred share. But this is substantially disproportionate. So we're looking at you vastly reducing your ownership relative to other shareholders. And the reason we're doing that is because that's when we're going to give you exchange treatment. Capital. If you don't meet this, then you fall with the second one. You got to meet the second. Sorry, let's do substantially disproportionate for a moment. So this is 7/18 August.
Yep.
Assume one is not related to either Jacob or Jeannie. This year, SCR redeemed 5 shares of Wall stock for $25,000. Wall has its tax basis in the 5 shares of the SCR stock of $10,000. What is the tax treatment of the stock redemption to Wall under 32B2?
So 302B2 is just the rules that we're talking about on stock redemptions. So people say 302, that's what we're testing.
$25,000 dividend to the extent of SCR EMP. Prior to the redemption, Wall owned 20% of SCR. After redemption, his ownership percentage in SCR dropped to 16.67%.
So remember, we're going to be going through these tests, these 3 tests. And so after, the first test is after, do you own less than 50%? The answer is yes, he didn't own 50% to begin with. But the first prong is just an after test, and are you below 50%? The answer is yes. Okay.
This redemption doesn't satisfy the substantial disproportionate test. After redemption, Wall owned less than 50% of SCR stock, but his ownership percentage after redemption does not fall below 80% of his ownership percentage prior to the redemption. Wall will not be able to treat the redemption as exchange under 302B2 changing ownership test unless he can satisfy one of the other changing ownership tests. Wall will have 25,000 dividend assuming SCR has sufficient EMP rather than 15,000 capital gain.
Yeah, so a couple things. So this, then we fall to the second test, and we're looking at, did it have an 80% reduction in percentage ownership? And so 80% of his prior was 20%, so he would have to fall below 16% to meet that second test. And he's at 16.67, so he didn't have enough redeemed. So maybe one more share, and that could, the math could have worked, but it's an objective test, right? Less than 50%, or less than 50% and less than 80% of what you own before. And I want you to think about this when you're thinking about this. Think about what's at stake in the determination, right? You're either a distribution or you're an exchange. So that's down at the bottom here. And so since he did not meet these tests, it's a distribution. And the earnings and profits are sufficient to cover the amount distributed. So he had a $25,000 dividend. Okay? If he were successful in meeting one of those tests, he would have had a $15,000 cap gain. And that's because you recover basis in a cap gain. You don't recover basis in a dividend. To the extent of the dividend. So that's why this is important to understand this, because what are the implications to the shareholders? Is there a question? Yeah, George.
Yeah, it's different from that. Like if the acquisition is by a subsidiary, would you treat it as?
Yes. So redemptions can happen anywhere in the organization. So whenever there's a corporation and it's sending money to its owner, and that could be within a large group, and parent sub and then sub 2 making a redemption of sub 1 stock, that can be tested under redemption. Now what you're going to find is it's going to be really hard to meet these tests. So you're going to be treated as having a distribution in those related party different settings because when we talk about how we determine these percentages, it's going to take ownership. It's going to take ownership of related parties into account. So when you're in a big group organization where there's multiple corporations that all own 100% of each other, you're going to count all their ownership, so you're not going to be able to ever meet these tests. So yes, technically you can have a redemption form, legal norm, but the rules are going to frustrate you and treat you other than that. Okay. So we're still in substantially disproportionate. So in determining whether the above 50 and 80% requirements, what we were just talking about, a shareholder must include stock constructively owned through family members or entities controlled by the shareholder. Okay? So I am not just looking at the shareholder who was redeemed. I have to look at related parties to that shareholder, and I count their ownership in determining the 50 and the 80. And I have to count the related corporations and other ownership, chains of ownership will count as related parties as well. That's why these rules will frustrate that. Why is it doing that? Because it's looking at, did you really have a substantially disproportionate distribution if you still own a significant amount through a sibling or through a child? Or through George's example, a parent still owns the same stock in the global organization. So that's those constructive ownership rules will hold other amounts in there. And it prevents shareholders from dispersing stock ownership among related parties to avoid having a redemption treated as a dividend as well. So people could get cute and disperse their ownership, try to have a legal form redemption and treat that as an exchange for tax purposes when you still have ownership via control of related parties. 719 is Nathan.
Okay, so return to the amended storyline in which Walt is Jacob's father in exchange for contributing $50,000. He received 25 shares of SCR stock and 20% ownership of the company. This year, SCR redeemed 6 shares of stock from Walt in exchange for $30,000. Walt has a tax basis in the 6 shares of stock redeemed at $12,000, so $2,000 a share. How many shares of SCR is Walt deemed to own? Furthermore, what is the tax treatment of the stock redemption to Walt under these rules of 302?
So we're dealing with two individuals, right? Walt is the father and Jacob's the son, and we're going to do the 50% and the 80% test on a client. Okay.
And so the answer is then that you take Walt and he's deemed to own 100 shares, and the redemption is then treated as a $30,000 dividend to the extent of SCR's E&P.
So Walt owns 25 shares, right? So I think in the earlier facts, Jacob owns 75 shares. Walt is deemed to own what Jacob owns because Walt is related to Jacob. So he owns 100% of this, okay?
Yep. And so prior to the redemption, Walt owned the 20% of the shares directly, and then under the family attribution rules, Walt is treated as constructively owning the shares of SCR stock owned by Jacob, so that's 75 shares.
So I messed up my math. So 125, there must be a third shareholder here. Because Walt owns 20, Jacob owns 75, somebody owns the balance to get the 125.
Yep, and then so Walt is treated as owning the 100 shares of SCR stock, so that's the 25 and the 75 combined, and then 80% of the overall stock, so that's 100 out of 125. And after the redemption, Walt's ownership percentage in SCR drops to 79%, and it does not satisfy the substantially disappropriate test because Walt is deemed to own more than 50% after the redemption. And so he then owns, as a result, he will have a $30,000 dividend, assuming sufficient E&P rather than the $18,000 capital gain.
Yeah, so the redemption was structured legally as 6 shares of stock were redeemed, right? So the numerator just went down from what Walt and Jacob both owned collectively from 100 down to 94, and the denominator went from 125 down 6 to 119. You don't even get in the front door of these rules because you own greater than 50%. Directly and constructively, right? So that counts what the son owns as well. And then the last sentence is what I was asking you to do is think of the end result of what happens here. By failing to do this, that means the entire amount distributed, assuming sufficient E&P, is a dividend to Walt, as opposed to an $18,000 cap gain, which was $30,000 less than $12,000 in basis. So no basis recovery. Okay, perfect. Thank you. Okay, 716. Here.
Assume that Walt is not Jacob's father, and besides his 25 shares of SCR that he owns directly, he's a 40% partner in a partnership that also owns 25 shares in SCR.
So this is going, not family relationship, but business ownership relationships can give rise to count other shares than what you own directly.
The other 60% of the partnership is owned by neighbors, Fredia and Echo, who are unrelated to Walt. How many shares of SCR is Walt for this owning directly and indirectly to the partnership? So he owns 25 shares directly, which is not the first question, and then another 10 shares indirectly. And distributed as indirectly owned as a greater share of SCR stock owned by the partnership, because it's the 40% partner partnership times 25 shares, which is 10 shares, and then that times 45 shares.
Yeah, so a couple things on here. So indirect ownership is always looking through an entity that you own a substantial part of that then owns something. So then you own that something that the entity owns. So that's why he picks up 40% of the 25% of the 25 share that the partnership owns, giving him 10 additional shares. Now, in the facts, it also says the other 60% of the partnership is owned by his neighbors. Even though that might be a super friendly relationship and the neighbors for some reason might do everything that Walt tells them to do, that does not count. These are objective rules. So I put in the bubble here. There are explicit rules that determine the family relationships and the relationships among shareholders, corporations, and partnerships and their owners. So don't get sidetracked by, oh, his best friend owns 25 shares. That doesn't matter. He's not related to his best friend, right? And so it's only explicitly what the rules tell you. And when you get questions like this in real life, you just have to go find the rules and blast through them. Because, you know, does an in-law count? Does a stepson count? All those things you have to just blast through the rules and understand what particular relationship you're dealing with and does it count or does it not. Okay?
So assume now that Walt is a 40% shareholder in Acme Corporation, which owns 25 shares in SCR. The other 60% of Acme shares is owned by his neighbors, Fredia and Echo, who are unrelated to Walt. How many shares of SCR is Walt shares owning indirectly through Acme Corporation? This would be 0 because no shares of the Acme Corporation are attributed to Walt under the constructive ownership rules because Walt does not own at least 50% stock of Acme Corporation. And stock owned by a corporation is attributed to shareholder only if the shareholder owns at least 50% corporation stock. So in this case, Walt only owns 40% of Acme, and therefore SCR shares owned by Acme are not attributed to Walt.
So those two, that what if and the one above it, you see a difference in the rules between the ownership you have in a partnership versus the ownership you have in a corporation. The ownership in a partnership doesn't matter. I got a, that's not even mine. Zero in here. Let's continue. So, okay, so the first example, there was no threshold by which you needed for the ownership to look through the partnership to what the partnership owns. So that 40% was enough, you own 40% of whatever the partnership owns. Corporation has a floor that you have to get over. You have to own greater than 50% before you're deemed to own with the corporation. So that's why you got 0 through the corporation. So that's just an example of when you're applying these constructive ownership rules, you have the exact relationship and find a rule.
So lastly, assume that Walt is a 60% shareholder in Acme Corporation, but owns 25 shares in SCR. The other 40% of Acme shares is owned by Cleavers, and not all of Walt. How many shares of SCR is Walt treated as an indirectly to Acme Corporation? So it'd be 50 shares because Walt is treated as indirectly owning a voting share of SCR stock owned by Acme. The 60% shareholder has 25 shares, and then a quarter of Acme stock in SCR is treated Walt because Walt owns over 50% of the stock of Acme Corporation.
So this is not changing that 50% and 80% test, it's just changing the percentage that you're testing against the 50 and 80%. So related party rules are fascinating. They sit in separate areas in the Internal Revenue Code, and if a section is using it, they will send you to there. And they say, well, if it's a related person as defined in X portion of the tax code, then apply that here in determining these ownership percentages. So you have to go there and then again, get very granular with your facts. What do they own? What's the relationship between them? And what is that okay. So in this instance, the tax basis in shares legally redeemed but characterized nonetheless as a dividend for tax purposes, for which the income inclusion is not reduced to reflect the recovery of tax basis that it would have been if it were a taxable exchange, is added to the tax basis of in any remaining shares owned by the shareholder or the shares owned by another that was considered effectively owned by the shareholder. What this is saying is, if I have a legal exchange, the basis in the shares is gone because I don't own the shares anymore, right? So legally, I don't own the shares. I delivered those back to the corporation. But if I didn't meet one of those rules, it was treated as a distribution. So the idea is, well, what happens to the tax basis in those old shares, right? It was never recovered because I didn't have a capital gains transaction. And now the shares don't exist anymore, so what do I do with that tax basis? This is saying that if I still own shares in the corporation, so just because I drop below 50 and I have 80% less than what I had before, I could still own some shares, right? I can meet those thresholds and still be a shareholder. I would take that old basis for the shares that were actually legally redeemed and add those to my remaining basis, remaining shares. I'd boost that basis back up. The last part of this parenthetical is saying, well, if all of my shares were directly redeemed, but I had a distribution because of constructive ownership, some version of the test that we just went through, then I would send that old basis that was unrecovered in the redeemed shares and give that to the shares owned constructively by another shareholder and add that to it. I will tell you that rule is a little controversial with the IRS because they typically do not have a basis to go from one shareholder to another shareholder. But that is the rule today because the basis needs to go somewhere. Right? The basis just doesn't go into thin air. It wasn't recovered on the legal redemption. So that can cause the basis to jump over. Basis jumping, is what people call that. So 720 is Jacob.
In the preceding example, SCR redeemed 6 shares of Walt for $30,000, and the transaction was treated as a distribution because of the application of family attribution rules. Walt had a tax basis in the 6 shares of stock redeemed of $12,000, but this tax basis was not used in determining the taxable income from the transaction. What is Walt's tax basis in the remaining 19 shares of SCR stock? So the answer would be $50,000. Walt adds the unused $12,000 tax basis in the 6 shares redeemed, to the tax basis of the remaining 90 shares, which would have been 38,000. So 38,000 plus 12,000 is 50,000.
Yep, so that's just saying, he was caught, the constructive ownership rules caused him to have a distribution, not a redemption, an exchange. And therefore, that basis was never used, but those shares are gone, so you just take that basis and go out and run to the shares. Okay, so that's the first test, substantially disproportionate. I must have less than 50% after, and my after picture must be less than 80% of the before picture, both and guys, right? Very objective. The trick there is constructive ownership. Does that frustrate my ability to just look at my direct shares? That's in that application. So that's, I only have to be one of the three requirements to get redemption and exchange treatment. So the second one is complete redemption of stock ownership. So a shareholder having their entire ownership interest redeemed can treat the transaction as a taxable exchange. Constructive ownership rules apply to determine whether the redemption is complete. However, a distribution can elect to waive family attribution. So if I don't have any constructive ownership in my facts, and I have 100 shares before, and the company acquires all 100 shares of mine, I am dead stop, got exchange treatment. I'm no longer a shareholder. Okay, so family ownership or constructive ownership here is what's really could cause some noise in this particular area. So 721 is Eugene.
We return to the amended storyline in which Walt is Jacob's father and he owns 25% of SCR stock. Assume SCR is redeeming all 25 of his shares this year for $125,000, and for the year SCR is currently in fee of $500,000. Walt's tax basis in the SCR shares is $50,000, which is 25 times $50,000. Under the family attribution rules, Walt would still be treated as indirectly owning 75% of the SCR stock, as Jacob would own 75 of the remaining $125,000 payment will be treated as a taxable dividend to the extent of SCR PNP.
So that's even though he was directly redeemed 100% of his stock, he is still deemed to be a 75% owner via his relationship to his son, who's the shareholder. Right? That will frustrate him after he tell us about that.
We want to see how Walt can change the tax treatment of the complete redemption. And because Walt has redeemed all of his shares, he can waive his family attribution rules, provided he files an agreement with the IRS and does not retain prohibited interest in SCR as an employee or consultant. And by waiving the family attribution rules, Walt will be treated as not owning any SCR stock, and thus will be able to treat the redemption as an exchange for a capital gain of $75,000.
So what's important here is he has to have legally redeemed all of his shares, right? Because think about in a family-owned situation, a founder and the family members who own this, you would never be able to get to this because you're always going to be deemed to own what your family owns. And so this allows that person to exit the business at a redemption, an exchange, and recover their tax basis by waiving their family attribution. If he still owned one share, he won't be able to waive the family attribution. And this would have been a dividend. And again, I would ask you to think about what is the result of the binary aspect of this. And this allows him to cut his inclusion down to $75,000 because he recovers that $50,000 of tax basis in the redemption. If not, it would have been $125,000 dividend. And again, they give you the facts here that there was sufficient to cover that. Okay? All right. That's complete redemption. Right? The only noise there is that family ownership that would preclude you from that, but it makes sense that you can waive that because if not, you can never have a complete redemption in a closely held business. Okay, so the third category is redemption is not essentially equivalent to a dividend. Okay, so we're trying to protect against avoidance of dividend treatment, right? So this is not essentially equivalent to a dividend. So So this is a subjective determination that turns on facts and circumstances. There must be an undefined but meaningful reduction in the shareholder's ownership interest as a result of the reduction. Neither the IRS nor the courts have provided any mechanical tests to meet this standard. Besides that voting power must be less than 50%. If you own greater than 50% after the redemption, you are never going to get redemption. You are the controlling person of this. And so that makes sense. Think of the most egregious example. You have 100% owner of the corporation. If I allowed them to get redemptions, then I'm letting them lower their tax by getting cash out via some basis recovery. When nothing really changed. If I own 100 shares, and after the redemption I own 90 shares, I still own 100%. Nothing's really changed. So that's the most egregious example. They just say if you own greater than 50%, you have that control. So the control element, unless that leaves the equation in the redemption, you're just not going to get a change. And it's always going to be dividends. So even in this third test, you have to be below 50%, or you're just not going to be able to get there. So if you're less than 50%, then you can desire to exchange treatment turn on this test only when they cannot meet the required two tests. Right? You can meet objective tests, you're going to be way better off and more comfortable than trying to argue a subjective test and risking the government disagreeing. So, 722 is Abigail.
Okay, so assume that Walt is not related to Jacob or Jenny. This year, the SRC redeemed 5 shares of his stock in exchange for $25,000. He has a tax basis in the 5 shares of the stock of $10,000, and assume that the SRC has sufficient immunity to cover any distribution. What is the tax treatment of the stock redemption to Walt under the not essentially equivalent to a dividends test? So he would have a $50,000 capital gain, which is just the $25,000 minus $10,000, and then he originally owned 20% of the SRC, and afterwards he only owns 16.67%. So he does not satisfy substantial test.
Because that wasn't less than 80% of what he owned before, so he had dropped below 16.
But he could argue that it's to be treated as an exchange for the not essentially equivalent to a dividend because his ownership decreased and it's below the 50%. But also it's not guaranteed, so he might ask to redeem one more additional share so that it was.
Yeah, so this is just saying it's better to be an objective test than it is to be subjective. So if you just can we agree that we do one more share, then I'll fall below that 16%. I'll say it's substantially disproportionate. The government can't argue against that because it's math at that point, right? Whereas if I'm not, then I'm on this more subjective test and I'm trying to argue that it's not substantially. Okay, 723 is Eric.
Walt is Jacob's father and SCR redeemed 5 shares of his stock in exchange for $25,000. Walt has a tax basis in 5 shares of SCR stock, $10,000, $2,000 per share, and SCR has sufficient immunity to cover any distribution. What is the tax treatment of the stock redemption to Walt under the not essentially equivalent to a dividend tax? Would be $25,000 different to the extent of SCR immunity prior to the redemption. Walt is treated as though 80% of SCR. 35 shares directly and 75 shares to Jacob, and after the redemption, his ownership percentage in SCR drops to 79%. He was not 95,000 shares, and his redemption does not satisfy Walt is treated as
So this is just saying that constructive ownership rules can come in again in this test and frustrate your ability to fall below the 50. 50 is just, you're not going to be argued, you can't argue that it's not essentially equivalent to a dividend unless you're below 50. So you got to also be careful of those related parties there. Okay. So that's that's to the shareholder, okay? So to the shareholder, are you getting exchange treatment, are you getting dividend treatment? It all depends upon whether you meet one of those three tests. So, what's the tax consequences to the corporation? Okay. So, if we're distributing cash, so remember we talked at the start, cash dividends, there is no gain or loss in US dollars for a US person. So, no matter what the value, if the value of the dollar goes down due to inflation, that's irrelevant to the tax code. You have full basis in US dollars at all points in time. So, a redemption, sending cash out in exchange for stock causes no taxable event to the corporation. So remember when we talked about non-cash dividends? So if I distribute property out that is not in the form of cash, that can support the dividend, the fair market value, but that has gain trigger for the corporation. Property that has a gain in it is distributed out of the corporation. I can recognize gain. I do not recognize loss. Right? The same rules we talked about last week. Same rules as a dividend or non-cash property. I have to account for the non-cash property being owned by a separate taxpayer before, and it's not owned after. That's going to trigger the gain, but not the loss. Okay? The E&P implications here are kind of interesting. So, if the redemption is treated as a distribution, so none of the three tests we talked about would have been met. The corporation reduces the E&P under the general dividend rule by the amount of cash distributed, and for non-cash property, remember when we talked about non-cash property, we had the greater of fair market value of adjusted or adjusted basis. That was the rule. Same rule here. So it's effectively saying when we treat it as a distribution, it's treated as a distribution. Right? We don't have a legal exchange, even though we have a legal exchange, but we don't follow the legal form. Okay. The second part is the more important area. So, if the redemption is treated as a taxable exchange, i.e. one of those three tests is met, the corporation reduces the E&P by the lesser of the ratable share of E&P attributed to the redeemed shares or the fair market value of the property distributed. Right? If you guys, when I think I sent, when I post the slide deck, you start a PowerPoint form, so I think you can see the review notes I put over there, review comments. So I articulated why this is the rule. Because again, I like to think of why is a rule as opposed to doing the inhuman, impossible thing of trying to memorize every rule. So this is one of those rules where I can never remember this rule. So the reasoning behind this rule is if I have a redemption that is respected and follows the form of the legal redemption, so there is an exchange, so the shareholder does not own those shares anymore, right? They've been brought in-house as treasury shares. So the first portion of the lesser of the ratable share of E&P attributable to the redeemed shares is saying the corporation, if it's treated as an exchange, should reduce its E&P balance by the amount of E&P related to the shares that were redeemed. If I didn't do that, then the E&P jumps over and is associated with other shareholders. Because the E&P is still in the corporation, there's less shares outstanding. Because I acquired the shares that I acquired in the share redemption. Right? So that's the ratable share of E&P attributed to redeemed shares. The second test, or second item I'm going to consider is the fair market value of the property distributed. Remember when I started and I said E&P is a measure of the economic ability to pay a dividend? So we started with taxable income and we made adjustments to it to compute our E&P. If I distribute value out, that by definition lowers my economic ability to pay a future dividend. So the fair market value distributed out should be one of the items I look at. The reason I take the lesser of is because the rules are trying to balance the difference, the two competing rationales. One, I want to reduce E&P so it doesn't affect other shareholders by the shares that I reacquired, so I need to take out a ratable share of the E&P. But I also don't want to take that out if the fair market value is lower than that amount. because that's my economic measure of earnings and profits, is the ability to pay a future dividend. So I don't want to take it out if the fair market value is less than that. So it's a very odd rule, but the government is just trying to balance two competing goals. Not have E&P be shift over to other shareholders, but also the overall economic measurement of the ability to pay a future dividend. So that's the best thing I can tell you about that rule. I won't obviously go into that level of granularity, but I wanted you to understand this. And the review comments right. Okay, let's apply that in 724. This is August.
I just gave up because one question for one person only, I thought, so.
You want to do something?
Yeah, sure, I can do it. Assume SCR redeemed all of the 25 shares owned by Wall in exchange for $125,000. The stock redeemed represents 20% of the total stock outstanding. Wall has tax basis in the SCR shares of 50,000. Further assume that Wall treated the redemption as exchange because he waived the family distribution rules and filed an agreement with the IRS. As a result, Wall recognized a capital gain of 75,000. The redemption took place on December 31st, on which the SCR had accumulated EMP at the end of the year of $500,000. SCR did not make any distribution during the year.
So sorry, this is an example. When we get into the M&A stuff that we're going to cover in the next chapter, I always like to go through each party to the transaction, right? So the three tests we started with on redemptions, that's at the shareholder level. So to be thorough in your tax advice to someone, you analyze each party to the transaction. So we know what happens at the shareholder level. This is now what happens at the distributing corporation level, because they have an event as well.
By what amount does the SCR reduce its EMP as a result of this redemption? $100,000. SCR reduce EMP by the lesser of $100,000 or $125,000, the amount paid to Wall in the redemption.
So this is the lesser of rule. So the ratable share of EMP associated with the redeemed shares. So 20% of the shares were redeemed in the math. I'll assume that's the right calculation. And the EMP in the facts is 500,000. So the shares that were redeemed that were outstanding would have been entitled to $100,000 of the EMP. They are no longer outstanding, so I want to pull that EMP out. If I didn't, it would then spill over and impact other shareholders. And the 125,000 is the amount of property that went out. So I take the lesser of those two, and that's the rationale I'm trying to articulate in the bubble I was trying to articulate earlier. And obviously, the lesser of is the 100,000.
Assume EMP was $1 million at the end of the year. By what amount does SCR reduce its available EMP as a result of this redemption? The answer is $125,000. SCR reduced EMP by the lesser of $200,000 or $125,000, the amount paid to Wall in redemption.
So this is just trying to say that the appropriate measure here is the amount of value that left the corporation to support economically future dividends, and that's 125, so we take the rest of that. So I'll grant you that this is a difficult area, but that's what they're trying to do here with the lesser of rule, balance those two. Okay, so we covered a lot in chapter 7, but dividends, the whole thing on dividends, right, is those 4 scenarios that we're looking at. Current EMP and accumulated EMP, and the ability for one or the other to be positive or negative. So I got 4 iterations, right? Going through and making sure you understand what those 4 implications mean. Non-cash property distributions is that adding that corporate level element, because I'm now not doing the dividends in cash. I might have a gain recognition event if I distribute appreciated property to fund my dividend with the same 4 tests, or the same 4 scenarios of EMP still apply, right? Because it's still a dividend. And then stock dividends, that's when additional shares are given to existing shareholders, right? And there's nothing magical about there. It's non-taxable. as a general rule to the shareholders, I have to divide my basis and spread it across all the shares I own now. And the one distinction there is if I have a choice between receiving cash or stock dividends, I have to make it taxable. And then stock redemptions are the legal forms of the share buyback that would, do we respect the legal form or do we follow it as still as it is? Okay. All right, so let's move on to chapter 8. So here, we're starting M&A stuff, okay, mergers and acquisitions. So M&A, if you're looking at this from a finance perspective, usually means acquisitions and dispositions. From a tax perspective, M&A means any kind of corporate level transactional thing. So not sales of inventory and things like that, but transactional things that adjust the corporation itself. Certainly be acquisitions of divestitures. It could be formation. We're going to start with. It could be liquidation. Those are all under the umbrella of M&A. Okay? So if you're an M&A tax professional at a Big Four accounting firm, you're doing everything around this: formation, acquisitions, and liquidation. Okay. So we are going to start with transfers to a corporation. We're going to get a good way through that this morning. Finish that on Wednesday, and then we'll dive into the acquisition stuff, which is most people think the most interesting part of tax because it's very transformational. Public transactions are there. And, I used to always joke, my mom would read about something in the newspaper from a local company and say, hey, why don't you try to get some work on that? I'm like, Mom, I've been working on that for 6 months. Haven't been able to talk to anybody about it. Those type of life events, major transformational transactions, either on the acquisition side or the sell side, can be very interesting. We'll break that down between taxable acquisitions and non-taxable acquisitions. You might think, why wouldn't I always want to do non-taxable? There's going to be requirements to be non-taxable. And you may or may not be able to get that based on how the deal is structured. Deal involves cash, so a buyer is delivering cash to the seller. Whichever side you're on, that you're liable to be in the taxable acquisition. You can't exchange something for cash and not have a taxable transaction. If you can do something other than cash, company stock, I might be able to get you into a non-taxable transaction. Sometimes the business negotiation is going to dictate where you're at. Sometimes it's the tax profile. If somebody has a loss, they might want a taxable transaction. Loss. We're going to break them down, both of those things. And reorganizations you've heard about. Those can be in an acquisition setting. They can be in an internal setting in corporations. That's going to fall in this bucket of non-taxable acquisitions as well. And then we're going to do liquidations. I like to think of it as the lifeline of the corporation. From the formation, how do we start the corporation? And then when the corporation's up and running, what are we doing from a transactional standpoint, from a life event standpoint? Are we acquiring things? Are we divesting of things? And then all the way to the end, if and when someone wants to liquidate the corporation, what does that look like in winding up the affairs of the corporation? Okay, so forming a corporation always typically involves the transfer of assets or property. I'm going to use that interchangeably, assets and property. The tax code uses the language of property, but you can think of it as assets if that's easier for you. But forming a new business requires the owners to choose a type of business entity for its operations and typically involves the transfer of property to a corporation and possibly assumption of liabilities by the corporation. So I have to get the corporation started, right? It has to have either at a minimum cash to acquire some asset, but you might have some other property that might be used in the business. So it could be equipment, it could be land, it could be anything that the owner is then transferring to the corporation to get the corporation started. It could be a change in the form of an existing business. So changing a sole proprietorship to a corporation similarly involves that transfer of assets from one taxpayer, the sole practitioner, to another taxpayer, the corporation that you are starting, and possibly the assumption of liabilities. So it could be a brand new business, you have an idea of doing something and you want to do it in corporate form. You might start the corporation and transfer the assets into it or get started. Or it could be something you've been doing otherwise, either in sole proprietorship form or partnership form, and you decide you want to start doing that operation in corporate form. You are forming a corporation in both instances. Okay? The following initial tax implications arise. So, think about two things here. Do I pay tax on the transfer of those assets? Because when they leave the owner's hands and go into the corporation, they've changed taxpayer ownership, right? And that usually is a taxable transaction. So the transfer of property and liabilities to the corporation results in a realization event, right? Remember, realization event is I don't own afterwards what I owned before. There's been an economic exchange. So before I owned assets or property, after I owned stock, right? So I've realized the gain or loss. And can result in recognition of taxable income. So the government will have conditions here, I'll talk about them in a moment, that if I meet those conditions, then I have no recognition of my realized gain or loss. Okay. The shareholders of the corporation will need to calculate their tax basis in the stock that they receive. Right? I had stock in assets or property. I don't own that anymore. Now I own corporate stock. What's my basis in the stock? And you can imagine the corporation needs to calculate its tax basis in the property it receives. Why does it need to do that? Because we have depreciation and amortization of assets at the corporate level. Right? So they need to know when they get assets coming into the corporation, what's my tax basis in those assets? So do we have gain or loss? And then what is each party's basis in the property that they receive? That's where I think you need to think about it holistically. Look at everybody's implications of the transaction. I'll help you out. Okay. As a general matter, unless the transfer meets specific requirements to be non-taxable, transfers to a new or existing corporation are considered taxable dispositions of the transferred property in exchange for stock. So it doesn't matter if you're forming the corporation or it's an existing corporation that you're putting additional assets in. Okay? As a general matter, it's taxable until the government tells you it's not. Right? That's the same power of the pen we've always been talking about. It's in gross income unless we tell you it's not. It's not deductible unless I tell you it is. So it's taxable until I tell you it's not. Okay? And if it is taxable, the transferor recognizes gain or loss equal to the difference between the fair market value of the stock received and the tax basis in the property transferred. It's the same gain or loss as if you had sold the property. Okay? Remember, it's always amount realized less my basis equals my gain or loss. If I transfer that to the corporation, and it's the value I get is the stock value of the stock I received. I have basis in the assets transferred, that's my gain or loss, if it's taxable. And if it's taxable, the recipient corporation takes an initial tax basis in the property received equal to its fair market value. That's the same basis as in a purchase transaction. Right? Someone purchases an asset for cash, they take a basis of an asset they get back equal to fair market value. Someone recognizes gain, somebody has basis of the fair market value. Right? So, as a general matter, I think it's taxable unless the government tells us otherwise. It's taxable. Gain or loss at the transferor level, fair market value basis at the transfer level. Section 351, I don't give you a lot of tax sections, code sections. 351 is a seminal code section in the Internal Revenue Code. It's been around as long as I've been practicing. It rarely changes. This is one of those good things that, the good thing about all M&A is it's a pretty static area. It's dense, it's hard, but it doesn't change very often. The government does not, when the parties change hands, there's a big tax bill, they don't go into this. They go into depreciation, that's really a right area. Tax rates, that type of thing, they'll go into in my international classes, they always tinker with the international regime. But this stuff, M&A stuff, they do not touch. What you're more likely to see is around the fringes on very, very niche issues. There might be a court case, there might be something the government wants to tweak on there, but the core framework of M&A activity is difficult to learn, but there's not a lot of change. I like these areas when I was in material because, okay, then it's just a matter of brute force of learning the material. It's not like that it's a moving target. Okay, so think of 351 as a deferral provision. Remember, we have exclusions, things that are never taxable, and then we have deferral regimes, which are not taxable now. But I don't want to forgive taxation. If you do something else in the future, I will tax you then. Okay? And we do that. A hallmark of deferral transactions is our basis determination. So we spend a lot of time thinking about basis when we're in these rules, whether it's non-taxable transactions. So 351 is our historic landmark code section talking about transfers to corporations. So, subject to specific requirements, Congress provided for the deferral of gain or loss, pure deferral, doesn't matter if I have gain or loss, involving certain transfers of property to a corporation in exchange for stock. The justification for deferral, so this long-standing position that we defer recognition here, is to remove tax impediments to conducting business in corporate form as the situation involves shareholders having a continued interest in the property transferred to a different form of ownership. So what I own directly in the asset, now I am still owned indirectly through my ownership of the stock of the corporation that now owns the asset. Okay, so I haven't sufficiently separated myself from the asset. That's what distinguishes a sale for cash, right? If I transfer something to you and you give me cash, I don't have any direct or indirect ownership on that asset. It's gone. You sell something on eBay for cash, it is gone, right? Whereas if I transfer the asset to a corporation, I get corporate stock. Through the corporate stock, I still see the asset. It's right there. It's indirect, but the government says that's not sufficient distance from the asset to warrant current taxation. Not forgiveness of taxation, not exclusion forever, but not now. Okay? In other words, the transferor is not substantially disposed of the transferred property. As in the basis of deferral transactions, gain or loss is preserved via the tax basis the transferor takes in the stock received and the tax basis the corporation takes in the property received. So that basis determination is how the government protects itself on deferral. To make sure they're not forgiving tax, it's just not now. Maybe sometime. So 351 applies to transfers of property of both C corporations and S corporations. Remember, we had C corporations and S corporations. They're both corporations under law, state law, when I form them. Remember, I can just, if I have certain ownership characteristics, I can elect to be taxed under subchapter S, which is flow through. We're going to talk about in a couple of weeks, S corporations. But forming those and having that election under subchapter S, both I have to get the assets in the corporation. 351 governs both of that. Okay. So here's the long-standing 351 requirements. So I have to have all of these. One or more shareholders must transfer property to a corporation. The whole distinction there is going to be property. Services do not count. Property, so tangible assets and intangible assets. Property. The transferring shareholders must receive stock in the transferring corporation in exchange for the property transferred. That's that connection that took you from direct ownership to still indirect ownership in the assets. So that makes sense. I have to receive stock. If I receive anything other than stock, I don't have that indirect view towards the assets, right? And then 3 is a big part. immediately after the transfer, the transferors, and that's plural, must collectively control the corporation to which they transfer the property. That's the idea that I still have line of sight to the assets. I have control, I have ability, what I directly own, now I still have some direct connection to those assets because it's to a corporation in which I receive stock that I am now in control. When those three requirements are present, deferral of gain or loss is required. So a couple of things there. Loss is deferred. Right? Normal tax planning, we don't like to defer losses, right? We like to recognize losses. Well, if you meet these three requirements, you're deferring the loss. So if you have an asset that is desired to put in the corporation, you might have a loss in it, right? You might have overpaid for it relative to its current value. It still has value, but you won't get to recognize that loss if you meet these three requirements. Okay? Just keep that in mind. If you wanted to recognize the loss, don't meet one of these three requirements. It's an objective test. Don't take stock back. Sell it for cash. You can recognize your loss. So just be cognizant of that. You're either in or out on an objective test. And it's required. So you can't, oh, that's okay, I don't care about deferral. You can recognize it. No, it's required. It's the word shall, not recognize. Okay? So let's talk about these individually. So one or more shareholders must transfer property to a corporation. So property is extremely broad. Cash, tangible assets, intangible assets. So patents, customer list, trademarks, logos, all assets, right? Think of anything that a business can use. If you're starting that business, the government wants to incentivize your ability to transfer that property in there. So it's extremely broad. The one exception you have here is services are excluded from the definition of property. So in case where a shareholder receives stock in exchange for services provided by the shareholder, that shareholder will recognize taxable income equal to the fair market value of the stock received. Think of that as I'm being paid for my services. Right? I normally want to get paid for my services with cash. But if someone says, I'm a little short on cash, but if you provide services as a corporation, I'll give you stock in the corporation, you're getting paid for your services. That's taxable income. Right? So that's the only distinction here. Property is very broad, services is excluded. So 8.1, sorry on that, George?
As part of a qualifying section 351 transaction, Guinea received 10% of the stock in 360 Air, valued at $60,000 in exchange for services in setting up the corporation. Will Guinea recognize the $60,000 of value realized in the transaction? And you say yes, Guinea must recognize the compensation income of $60,000 as a result of the exchange because services are not considered property under section 251.
Gotta do property, right? If I don't do property and I'm providing services and I'm getting stock in exchange for that, I'm being paid in the form of stock. That is tax.
Okay? Let's suppose that as part of a qualifying section 351 transaction, Guinea created a distinctive logo for the company and in exchange received 10% of the stock in 360 Air, valued at $60,000. Assume the adjusted tax basis of the slogan is zero because Guinea created it. Will Guinea recognize the $60,000 gain realized on the transfer of the slogan? The answer is no. Guinea will defer the $60,000 gain realized because intangibles are considered property under section.
So that assumes the next two requirements we're going to talk about is present, but this is property, so it will at least get through the first requirement, right? And it doesn't matter how esoteric the property is, right? It can be very intangible, but that still counts here. What just doesn't count is services. Okay, we'll pick up here, for Wednesday. We're gonna finish through, 351, and probably get to our